Hello and welcome to the How2Exit podcast, where we introduce you to a world of small to medium business acquisitions and mergers. We interview business owners, industry leaders, authors, mentors, and other influencers with the sole intent to share with you what it looks like to buy or sell a business. Let's get rolling. Hello and welcome to the How2Exit podcast. Today I'm with Jonathan Brabrand, and he's an author, entrepreneur, and expert in the field of advising business owners on the sale of their companies. Jonathan is a managing partner of Transact Capital Partners, which is a boutique M&A advisory firm headquartered in Richmond, Virginia. He has spent over 20 years helping business owners with a wide variety of industries sell their companies to their ideal buyer and achieve the exit outcome they dream of. His book, The $100 Million Exit, Your Roadmap to the Ultimate Payday, analyzes large mergers and acquisitions success and failures to draw practical, actionable advice that company owners can implement to increase the value of their business and better be prepared for exit. Welcome, Jonathan. Thank you for let me have you on my show.
Yeah,
I almost made
you
it
for
through
having
there.
me.
So I always get tongue tied on those, but it's part of the fun. It's like this is a real raw, uncut version of life, right? We're just going to chat about mergers and acquisitions. So it doesn't have to be
Sounds
polished in
good.
this space. So one of the first questions I ask every single time, is kind of how did you get into this space? What made you want to do mergers and acquisitions? And let's just start there. Let's get to know, who you are and how you got into this space.
Absolutely. Great question. So I started in this industry right out of college. And admittedly, what drew me to it from the beginning was a little bit self-serving. It seemed like the opportunities that I was looking at, I went to University of Richmond and got a finance degree. The opportunities that I were looking at coming out of college for entry-level positions all seemed pretty boring and seemed like they had very little responsibility. And then I stumbled across investment banking analyst. And the more I learned about it and talked to the people like the year ahead of me and 2 years ahead of me and what they were actually doing, it just fascinated me that people that young would have that much responsibility and exposure to senior people. So I got into it because it seemed exciting and fun. And it has been, but that was, over 20 years ago. And the reason I've stayed in it is because I really like working with entrepreneurs and business owners. I love hearing their story. I love, getting to know their companies and ultimately helping them with sort of the pot of gold at the end of the rainbow, helping them monetize what they have built over, sometimes generations. That's really, really rewarding to me. And I really enjoy that aspect of it.
That's awesome. So that's kind of why I've got into the same thing. I got in this space. I didn't realize how much I love talking to entrepreneurs until I was participating in a fairly large roll-up project, and ended up talking to a couple hundred marketing agencies over a very short period of time, like 180, 200 days. We were really, really active. Uh, 25, 30, 1 hour interviews a week, right? We were
Wow.
busy. And the thing I found most interesting is the origin story and their challenges and what they're trying to accomplish, and uh, really adhere to that. You said a couple of key times inside of what you just said of helping the entrepreneurs get where they want to go.
Hmm.
That's what I want to do when I'm on the phone with these guys. Is I'm not like, hey, do you want to sell your business? Like, where do you want to get, and how do we get you there, right?
Right.
So,
Right.
and that's important. I mean, a lot of people don't understand the psychological side of this. We were talking about this on the previous show. Is a lot of the exits people are doing, money is not their highest motivator, right?
That's right.
They'll,
Absolutely.
if you're selling, you want to get as much as you can. When you draw down the line of I can get as much money as possible, or my brand will still exist and my employees who've worked there for 30 years are still going to have a job. Most of these entrepreneurs are going to lean towards making sure their people are taken care of, and a lot of them are going to be interested in their legacy, their brand, right? So
100%. That you've touched on a couple of key things there. One is we've seen If we run a competitive process, the goal of it is to have multiple options at the end of the day for the entrepreneur or the business owner to choose from. And we often see people go, and I think rightly so, with the second or third highest bidder and not just go for the top bidder, the most money. And there's lots of reasons for that. That's actually one of the top mistakes that I see people make is overemphasizing price and not focusing on some of the intangibles that you just mentioned, because there's a lot that goes into making that perfect match, and it's not always the top dollar. Now, I will say there's a correlation, though. The buyers that find the most sort of complementary and not just like economic synergies, but culture synergies and a good fit, they often also seem to value the company the highest, and it sort of works well that the best fits also are towards the top of the range of value, but it's not always the case. And the other point that you mentioned that I think is really important is, a lot of times people think the exit is sort of the end of the line. To some degree, they put it off because they don't want this fun thing to end, and they wanted to delay what they think is like the finale. But in reality, the transactions that we work on are really all about creating new chapters. Really, for three different, there are three different new chapters that are created. The first one is for that business owner, entrepreneur, and their family about what's next for them. They, oftentimes will now have monetized and have some wealth that they can do other things with, whether it's family goals or philanthropy or travel or start other businesses in different industries. But it's also a new chapter for the company and where it can go next with a new partner or part of a new larger organization, and that could bring excitement to the founder to see that their legacy, to your point, is going to continue on. And the third is a new chapter for the employees and the new opportunities that new partner or that new strategic buyer bring to them. As a quick example, we had a company I sold a few years ago where there was a key employee that had basically been given as much responsibility as possible and was yearning for more, and there just wasn't any more to give. It was actually a woman to give her in this family-run business, and it was worrying the owner because she was such a key individual. And through the sale process to a much larger family-held business, I checked in with him a few weeks ago. She's moved up in the parent organization's ranks and has much more responsibility, is using her talents more fully than she could have in the smaller organization. So it's a great example of a transaction, providing new chapters for the employees as well.
It's interesting. I've seen that a lot in the marketing space because there's an inherent problem inside of marketing agencies where they get to a certain size and they've groomed this talent, trained out talent, and the talent's ready for bigger, more creative projects, bigger, like they're ready for like trying to do a project for Coca-Cola or PepsiCo or something big, but the
Right.
agency's still too small to land that type of client. So one of
Yep.
the things that the agency owners look for is like when we were looking at acquiring them is what were the opportunities for their employees to take on those bigger projects so they didn't lose them, right? They
Yep.
usually would train. One of the problems inside of that industry is you end up training your employees right out of a job, right? You train them
Right.
so they're so good they go somewhere else that can get those contracts, and it makes
Yep.
it makes a problem there. So interesting. Right now, there's just the market is just really. I'm personally, I think it's just really good. There's a lot of people, the baby boomers and stuff that are uh, coming out of COVID. They've had it, right?
Right.
And they're looking at what their next chapter is and stuff. I don't know that there's been a better time. Um, One of the reasons I'm in this space is I don't know there's been a better time in recent history to take a look at buying businesses and instead of starting from scratch. Are you seeing that
Mhm.
too? Are you seeing this like a good steady flow of just available opportunities around?
Absolutely, and that trend, the M&A market has been strong and continues to be strong. I think it's building momentum, partly because of just generational transfers that are needed. Second and third, fourth generations aren't staying in many businesses, and so that leaves those owners without a succession plan that maybe they had thought was going to be there, and therefore they're looking to sell. And the challenges of coming out of this, the last several years that has kind of maybe put some business owners to the point where they just want to exit. But one of there's kind of three markers that we counsel our clients to think about when trying to decide when the right time is to sell. And the activity within the M&A market is the number one, is the first one to look at. So you've touched on an important one there. The good news is, except for some particular little stretches across time, the M&A market is pretty robust, and there's some real reasons for that. We just talked about some of the supply in terms of businesses that are coming to market and will continue to come to market. There's also demand for those businesses, drivers there as well. Capital that's been raised in private equity funds, in historically low interest rates, even if they jump up some here in the next year or two, still historically low. Lots of cash on strategic buyers' balance sheets, where they need to show more growth to their stockholders than they can organically. And so making acquisitions is a stated part of their growth trajectory. So you have all these factors that are driving demand for deals, and then you've got the supply of deals growing, and it's a convergence of factors that leads to a seller's market.
Awesome. So you have a book out called The $100 Million Exit. So tell us a little bit about what's inside of that, and how you went about, like I said, you analyze large mergers and acquisitions. So
Yep.
what were some of the key lessons that you learned by analyzing the bigger deals?
Yeah, so the premise of the book is to, I think it's a pretty well known fact that large transactions, and we picked $100 million as sort of a template for what a large transaction might be in the eyes of many business owners. Large transactions, by their nature, get higher multiples. They sell for not just higher dollar prices, but a higher multiple of earnings. And some of that is based on pure size. But there's also aspects that I wanted to investigate to see if there's some things that could translate to business owners of any size. And that was sort of the premise of the book. And so I interviewed and drew from deal experiences that I've personally had to look at large transactions, and what are some of the takeaways that that led to those higher value exits, and what could a regular ordinary business owner take from them. So the first 2 or 3 chapters are all about preparing, and the idea of being in a sale ready posture, which I think is really important and is overlooked. And so that's the idea that you as a business owner, you should be ready to react to things from a sale perspective, even though a sale may not be in the cards at that moment. It may not be something you're actively pursuing. And so that involves things like building relationships with future buyers, even before particularly before you actually are asking them for any response or to look at any information. Getting in the habit of doing annual strategic planning and holding yourself accountable to reporting out the results of those plans, and starting to think about successor. Not just successor for the ownership of the business, but for your role in the business. Because ultimately, if you can't step back from the business, you have a job, you don't have a saleable business. So some of it is to get these ideas out into the hands of business owners who aren't ready to sell and wouldn't have come to find me in that mode of I'm now ready to engage your service to sell. The book was designed to get to them ahead of time and help make their business more valuable.
So on that topic, as you're going through your building a business and stuff, when's the right time to start identifying, if you're going to build it to sell it, or you're going to exit at some point, when is the right time to start identifying that end buyer? And how do you identify them?
Yeah, so 2 things there. The first one is it's going to sort of, I think, undermine the second part a little bit, but it's really hard to predict the ultimate single buyer. Now, we can certainly, I'm going to talk about ways to identify likely buyers, but in all the deals that I've worked on, it's rare that you could pinpoint with absolute certainty this is the group that will buy my company, and then run a large process, and that one group ends up at the end of the day. There's so many variables that can go into it. That being said, I think it's never too early to start that process, to answer your question. And so one of the ideas that we talk about in the book is identifying a handful of likely buyers, and that can come from in the industry, larger competitors, people in ancillary industries that you think, man, if I were partnered with them, we could do great things together. And so it's a little bit of a dream, a wish list of like who is like the best companies in my sector or in a related sector where I could see a lot of great fit. And if they had what I have and I had what they had, we could do great things together. And then just reaching out to them, again, without asking them anything, and saying, I'd like to introduce myself, to get to know you a little bit, tell you what kind of company I'm building, hear what types of things you're looking at in terms of acquisitions, particularly if it's a public company. You can do research on, what their stated acquisition criteria is or what some past acquisitions have been, getting them talking about what they liked about the last deal that they did and what they're looking for next. All that, it does two things. One, it influences your strategy, to your point. If we know that many of the buyers in my industry are looking for the same characteristics, then maybe I should make sure that I'm creating those characteristics in my business. And other input that you can glean can help decide how you set up your operations, how you expand. There's lots of things you can get from it. The benefit externally, though, is that you start a file essentially in their on their side of, man, I just talked to this really cool company. They're not ready to sell yet, but I like what I heard. I like what they're doing. They're doing cool things, and you check in with them, every year or two. Again, I'm not asking you to buy my business. I'm not asking you to value my business. I'm just letting you know what I'm doing, and the discussion is not anything. Confidential. It's really nothing more than they could find on their website. You're more putting a face to and a story behind what you're building, so that when the time does come and they hire someone like me, and I make a call and say, "Hey, I'm calling about a company. I think you may have heard of them, X, Y, and Z." Instead of saying, "Oh, that sounds interesting. I've never heard of them. Send me the information and I'll see." It's like, "Oh, I can't. I'm so glad that you finally called. I've been talking to that, on and off to that person for years. I'm excited now that there's an opportunity to actually do something with them." You've basically laid the groundwork for yourself to make that conversation, quick and painless.
So you mentioned the different criteria. Do you see that, the different buckets of buyers, for instance, private equity, family offices,
Hmm.
strategic acquisitions, competitors, and strategic partners, and that type of stuff, those type of acquisitions? Do each of those buckets kind of fall within the same rules, or are they kind of all wild, wild west and want different things when they do the acquisitions? Or, I mean, if I look at it, here's what I'm getting at. If I look at a business and go, you know what, if I did X, Y, and Z, I'd be really attractive for private equity companies, and they pay a decent premium for a company of this size.
Hmm.
Is that doable?
It is. So in many ways, they are both of those types of buyers are looking for the same types of things. So it's a Venn diagram. There's a lot of overlap in terms of high quality characteristics that both of those types of buyers are looking for. And keep in mind, private equity are looking to buy businesses that they may ultimately want to sell to a strategic buyer, but they want to help get it bigger in the meantime. So to some degree, strategic buyers are often sort of the end of the line, whether you go straight there or whether you go through one or multiple rounds of private equity before your business gets to that point. That's oftentimes sort of the way a business through acquisitions will evolve. But a key difference to think about as you're evaluating, as a business owner is evaluating those two different categories. So I'll put strategic buyers in one bucket and all types of financial buyers, family office, private equity, fundless sponsors. There's a bunch of different kinds of financial buyers, search funds, but in the same bucket. And the key care thing, and I would also say that we often counsel our clients to look at both. It's not like you're picking one or the other. It's to actually contact samples or a broad swath of both sides so that you can evaluate, maybe even meet with groups from both sides to determine which path makes sense for your company at that stage. But the main difference that we see is strategic buyers have a plan, a strategic plan that they're executing. They're heading in a certain direction. And what they want to know is, does your business help them further their strategic plan? Are you a puzzle piece that's missing from the puzzle they're trying to build? And frankly, if you're one of the last puzzle pieces of a puzzle they're trying to build, they're going to be willing to pay a premium to get to fill in some capability gap or talent gap or geographic gap. But they're on a path that they're looking to see whether you fit to help them in that regard. A financial buyer is different. They have no preconceived notion of a plan. They want to hear what your plan is and whether the capital and expertise and connections that they bring to the table can help accelerate the path that you're on. So there, the focus is much more on what is your business independently, where is it headed today, what could it do with more capital, with what could you do if you were able to make acquisitions of your own, bring in other senior level resources that maybe are outside of your budget today, but you would feel more comfortable doing if you had a financial partner. And so there's a difference there around, are you joining someone, you jumping on someone else's train, or are you getting an accelerant for the train that you're on?
So I have a lot of listeners that are actually in this space of buying companies, growing them, and then turn around and selling them. In that respect, are there industries that you see like you would avoid, right? They're just notoriously hard to get deals done inside of.
So it goes a little bit back to the what makes businesses valuable, and to some degree, valuation is just tied to perceived risk. So the perceived risk in a business, the higher it is, the lower the price, the multiple that a buyer is willing to pay. There are transactions that probably can get done in any industry for the right price. The challenge is trying to make sure you don't get stuck into an industry where the multiples are low because the perceived risk is so high. And so, investors, buyers of both strategic or financial nature, are looking to minimize risk that is outside of, essentially their control. And so where I'm headed with that is, highly cyclical industries that have a lot of regulatory exposure, where a change in a law could annihilate the profitability of a sector or the legality of a sector. Um, you know, Cannabis in the U.S. is an example where there's not a lot of investment because it's still federally not legal. But Canada it is a different situation. Cryptocurrency is another example that is seen as a little bit of too risky for most, not for investors of the capital, but for businesses based on crypto. But even some old, economy ones, a lot of construction trades where it's highly project oriented, and you don't have a lot of backlog. Maybe it's tied to, the government funding. A highway transportation bill, is an example of, that's kind of boom or bust. You get a gas tax hike, and those businesses are flush with cash, and then that wears out, and construction companies get really tight for work, and then it kind of goes again. So businesses that are highly cyclical, oil and gas is another example. Those can be challenging, and often buyers will look at a multi-year average, but they don't want to buy off a peak and get caught.
So, for instance, I actually had a group of investors come to me and said, "Hey, if you'll do a roll up and go out and acquire a bunch of veterinarian clinics, we'd like to be the buyer of them at the
Hmm.
other end." And then I did the
Yep.
research on it. In most states, an individual cannot. Oh, I think something like 40 something of the states, an individual cannot buy a veterinary clinic. What you have to do is set up a medical service organization, right? In
Yep.
that state, you own the MSO. The MSO can own the building, own the equipment, hire the doctor, but can't tell the doctor, the veterinarian, anything. They can't tell you. You can't tell them what prescriptions they can make or can't make, what procedures they can or cannot do, but you're
Yep.
pretty much their office manager and their marketing tool. And it's the same way with dentist offices and some other stuff. You can do a DSO in most states, but
Yep.
what that introduced was like about $25,000 to $30,000 worth of legal fees and setup fees in every single state you wanted to do it in. So we haven't
Right.
pulled the trigger on that one yet. But that just be aware there are some things out there that an individual just can't run out and buy without some extra, legwork and some extra legal paperwork. So,
Yeah, I mean, a great example of those to add on to that are many professional services firms. Like an architectural firm typically has to be owned by an architect. Many accounting firms have to be owned by a licensed CPA. Class A contractors have to be owned by a Class A contractor license holder. So there are definitely some of the more technical trades where that licensing becomes a key element of it. And maybe you could even buy the business, but you're dependent on, if you don't have the license, on the license of some person, that if they left, you would be out of business.
yeah, I bought a very small pest control company before I even took the courses on how to do this. to employ some relatives of mine that I really like. And funny thing is, I end up having to rebrand it and go out and get all the licenses myself because like you have to have the license in order. Like one of the owners has to be all fully licensed. So I'm really good at
Exactly.
taking tests. I went out and took all the tests. I never intend on touching a chemical. And then we realized that the previous guy that we got the equipment from, and we're in the middle of buying his customer list and everything, um, didn't do his paperwork right and didn't hold up to the standards. So we just pretty much did a startup. Like
Right.
we already had all the license, we already had everything. We even let my little daughter name it. It's if you can see that, it's Lullaby Pest Control.
Oh,
We
nice.
were brainstorming on what to call it. So my daughter at the time was 4 or 5, and she's like, you can call it Lullaby, but because you guys don't kill bugs, you just put them to sleep. I'm like, yeah,
Sleep.
whatever. Yeah, they're gonna sleep for a very long time. Um,
Exactly.
but yeah, I got that. Like I got that lesson the hard way, and then I just determined I like buying them as opposed to building them. I built quite a few in my past, but I went out and got trained and studied some different things to not buy myself another job, right?
Right.
Let's go
Right.
back to the exiting right. We had some discussion before this that we wanted to like kind of cover. What are the biggest mistakes people make when they're preparing for exit? So I'd love to get your insight on that.
Yeah, so one of them is waiting too long to sell. So if you think about the baseball analogy, you want to sell like in the seventh inning. You want to have some nice trajectory behind you, but you also want to have some pretty good opportunities ahead of you. The mistake business owners often make, and it ties back to that delaying what they feel like is some type of finale, is they just wait too long and they're in the extra innings. And the issue with that is, the business may plateau or even start to decline a little bit, and business buyers are buying the future. They're not buying the past. So the fact that you had your best year 2 years ago is good for you, but not good for the your next partner. And so they're really focused on what's the business going to do next year, and the year after that, and into the future, either independently or in conjunction with what they bring to the table. And so waiting too long, is an issue. They certainly are going to look at the historical financials, so I don't mean to disregard that, but they do that to one, understand where the business has come from, and to two, validate their beliefs about where the business is heading in the future. But again, what happened under your watch is for your benefit, not for theirs. So I'd say waiting too long to sell is a big one. Prejudging buyers is another one. So when the time comes to engage a firm and to run a process, there is always times throughout the process that you can kind of kick a buyer out if for some reason you learn something that is disconcerting to you, or you realize that they really aren't the right buyer for you. But so there's no commitment when you begin a process if you're going to contact a buyer that you have to consider them all the way through to the end. The mistake, though, is starting too narrow, and it ties back to a belief that I know that this buyer or this buyer is going to be the right one. We don't need to contact any others. And the challenge with that is you don't know what's going on in those buyers' boardrooms right now, and maybe they were a great buyer last year, but things have changed and they're putting out fires internally and they're not looking at acquisitions right now. Or they just made another one and that window's closed for 6 months until they can integrate that business. Or they are interested in your company, but they're going to pay you half of what what the business is actually worth. And because you've never had any real discussions, the fit sounds great, but when it comes to valuing the business, you're on two separate planets. And so allowing a broader universe of buyers to start, I think, is the right move. Understanding that you may be surprised positively with buyers that you didn't expect would be aggressive. That again, not knowing what's happening on their side of the table, they maybe have been looking for a business just like yours and just were more quiet about it. And you didn't realize it. And again, as you sort through the feedback, and it's definitely a two-way interview process. It's a little bit like a speed dating. You're getting to know them, they're getting to know you through this process, and we help facilitate that. If you learn something that is not going to fit, you can just say, I don't think this one's going to work. And by having more options out there and not putting all your eggs in one basket, you have that flexibility to, if you've met with 5 or 6, 7 groups and one of them kind of rubs you the wrong way, that's no problem. You've still got plenty others. Whereas if you start to narrow, it kind of pigeonholes you a little bit.
It's interesting you were saying that, the buyers buy in on the future. I would say, as a buyer, I think I would say we buy on the past. We buy on the future, but we pay on the past, right? So
Right.
we look at the EBITDA. It's a multiple of EBITDA, what you've done over the last 3 years average, and most
Yep.
of us are given some leeway. If COVID hits you, we look a little bit past the 3 years and kind of give you some benefit of the doubt inside of those numbers, just because it needs to be adjusted, right? And then, but if you don't have a future, if you can't show us like the trajectory where you're going, it's not a fool's errand, but it's a bad idea to just assume that you could do better than somebody that's running it for 30 years, right? So
Right.
if an owner comes to me and says, I'm at my wits end, I don't know how to take this to the next level, unless it's in my lane, like I've done it a bunch of times. If it's in
Right.
real estate or marketing or maybe computer security, I've been out of that for 15 years. I might take a deeper look because I might be able to figure out where we could take them that they didn't think of on their own.
Right.
The other 90 million industries that are out of my lane, and unless you can show me, like, I've got a team here, we have a path and we have a plan, I need to exit, and these guys can continue this plan without me. You lose me. You lose a lot of
Right.
investors that way, right?
100%.
So I totally align with that. I say we buy on the future and we pay on the past, from the buyer's perspective, right? There might
Absolutely.
be some, what's the word I'm looking for? Not brand equity. There's a name for it, like the performer, the looking for the future. There's some number or something given that you might get a slightly. If you can paint a very beautiful picture, you'll get a little bit higher of a multiple,
Yep.
because if we buy into it and we think your team can execute on it, they have a history of setting goals and achieving them, you know,
Yep.
then that opens up an opportunity for us too. So
Yeah, so a quick note on valuation. I agree with everything you just said. If we there is an art and a science to valuing private companies, right? So public companies, you can just see what their market cap is. You can add debt if you want to get to enterprise value, but they're priced every day, every minute. Private companies is not the case whatsoever, and it's very much the values in the eye of the beholder. There is a science element to it, and there are valuation models, and you can hire people to do business valuations for one purpose or another, and that's a good starting point, and a lot of buyers will use those as a foundation. But there is an art to it as well that is driven by competition, the need to fill a puzzle piece. From a financial buyer, that was more of a strategic buyer. From a financial buyer perspective, pressures that you may not even think about, like, we raised a fund and we've gone 9 months and we haven't put any capital to work, and this business was right in our wheelhouse. And I know the models say we ought to pay 50 million for it, but I'd pay 55 just to get my investors off my back that we got one done.
right,
And so if we were in a process and we got back after sending out, pre-qualifying people, they sign an NDA, they review the materials that we prepared, and we get a first round bid of just based on the book, haven't talked to anybody, we think the valuation range for this company is X to Y. And we laid them out just, numerically. You'd see this kind of bell curve, and you'd have some tire kickers, value buyers, they're hoping to get a good deal, but they're kind of underpricing it. You'd see at the peak of it, sort of where everybody is running those same models and they're coming out with basically the same kind of market value. And if we were going to tell you before running the process what your company's worth, we'd probably be in that same range. We want to give you a range that we have a high degree of confidence in delivering. But there'd be that other tail, that spike bidders, where they ran those same models, but there's something else about the future of the business, about something that they liked, about the team, about how it fits, that they're willing to go beyond that. And ultimately, it's not like a democracy. You're not trying to figure out a consensus of what everybody thinks the company's worth. You're trying to find that most aggressive spike bidder who maybe usually looks at 3 years of financials and averages them. But for this business, they're willing to just look at the last year and give you a multiple of that and not have the average play in. And so the purpose of running a process to some degree is to make sure that you're letting the market speak and you find the most aggressive buyer, not just the one that's in the highest probability range.
right. I noticed that you call your firm an advisory firm, and there's people out there that are investment bankers, and then there's a group of that are just brokers. What do you
Yep.
see as the big difference between like somebody reaching out and just going to a brokerage a Murphy's
Hmm.
brokerage or something like that, and actually
Yep.
working with what you would do as M&A advisory. Is there
Yep.
is there a clear difference between what those would be?
I think there is, and I think I have a lot of respect for business brokers, and I think they play a valuable role in the overall ecosystem. But the way that they work with clients and bring business, and ultimately we all sell businesses, but the way that they do it is different. And so, a business broker is typically working with smaller businesses that uh, uh, are more oftentimes looking for individual buyers. And so the approach that they take is typically similar to a real estate agent, where they will list the business without its name, but they will list it with an asking price and a little bit of information about it. And it's a little bit of the first come, first serve. The first buyer that has an interest that is can be at or near that listing price will engage with them, and we've got lots of businesses listed, and tell me what you're looking for. And we try to get those done. And that process works really well for individual buyers who are looking to buy a business they're going to get involved with, typically in the under $2 million range, if I had to put a number on it. Businesses that are 5 million and above, and there's a gap, sort of an overlap in between. In an M&A advisory firm or an investment bank, I'd use those synonymously. And like what we do is we don't list businesses, and we don't give us a listing price. We do probably more work up front to create a more robust set of offering materials about the business, and it's kind of split between historical facts and projections and opportunity and forward-looking information. We do research on likely buyers and identify likely buyers, work with our client to get those approved from them. And then we just reach out on an individual basis to those buyers. There's never anything listed. There's never anything publicly available. If you're not on the list, you would have never known that business was being sold. And frankly, if we reach out to you and you aren't interested in any acquisitions, or you're not focused on acquisitions of that type, we'll end the conversation, and you didn't know why I was calling to begin with. It's a very confidential process. The reason that this works well for larger businesses, it takes more time, it takes more involvement on the advisor's end, is that we run an auction process where, unlike that kind of first come, first serve, we have all those buyers on the same timeline looking at the same information, so that on a date certain, they all give us feedback. And it's like having a multiple bidder situation for a house. We can line them all up, excuse some, move forward with the others. There's gates later in the process where we have them rebid. And so you're kind of doing it once and doing it thoroughly and having them all compete, versus taking one at a time serially.
So you've been doing this for 20 years. Is there anything you know now that you wish you'd have known on day one of starting this whole process?
Um, I've seen a wide variety of businesses in all types of industries. I think the thing that gets overlooked the most often is the quality of the management team makes a big, big difference. And it's not just the owner, but it's that second tier senior management leadership that can make a real difference in the multiple and on the depth of buyers that are interested in your company. And I recognize it's hard as a small business owner to hire. They're typically the most well compensated folks in the organization. It's hard to make those hires. Sometimes they don't work out, but really focusing on your direct reports and finding the best individuals that you can for those roles will pay dividends when it comes time to exit. And being able to show a team that's capable and exceptional and has a plan, as you were talking about earlier in your example, whether it's a financial buyer or a strategic buyer, they're going to look to the quality of the team. And if you're wanting to step back, who's going to fill your role? Who's going to take the mantle forward? I think sometimes business owners think strategic buyers don't care about that. They've got management teams in place, and they just need your customer list or your product line or whatever. But they're thin too. They're looking for talent, and they may be able to do some of the overseeing of your business if it becomes a division of their organization. But they still need people on the ground in your facility running it, and they can help with some back office stuff. But they need the key people to keep moving your business forward. So they're looking at the quality of the management team, maybe just as much as the financial buyers are. So really investing in the senior management team, I think, is something that I've seen make a big difference over time that's often overlooked.
So in the deals, I mean, in the space in those you're looking at and the deals you got coming across, there's some what I'm seeing in the market is there's some real like hot spots, and from a buyer's perspective, I'm kind of trying to avoid them. So, for instance, SaaS, right, software as a service, the
Yep,
multiples on SaaS companies, good, well-run ones, are absolutely insane right now, in my view.
that's right.
Especially even the smaller ones, right? Even the smaller
Yep,
ones. The other one are the Amazon stores. What do they call them? FBA or whatever the Amazon stores. The
right.
multi I've got, a few friends that have some and they were offered 15, 20, some even as high as 30 times their EBITDA multiples on it. Like,
Wow.
sell it now before it cools off. You can build
That's right.
anything else you want. Just sell that thing right now while everybody's crazy overspending for it.
Yep.
So, and for those of you that don't understand what that is that multiple 3x or 30x, and from a buyer's perspective, that's how many years it's going to take to return that money. If you stay on the path they're on, you're paying
Hmm.
3 times profit or 5 times profit, and then and that or whatever the number is. In the case we were just talking, software as a service and those Amazon stores, selling products on Amazon, you're talking about a 20 or 30 multiple. You're not making all the money back for 20 to 30 years unless you drastically increase revenue, right? So it's a
Right.
very long play. So, are there any other industries like that are just kind of crazy hot right now that you know of?
So they come and go, and you mentioned veterinary clinics and dentist practices. That might be on the tail end, but that was definitely really hot. And there's probably some sectors that continues to be a really good place to have a business to sell. We've sold a number of businesses in those sectors, and they've done really well. Those are businesses that are seen as, I mean, fragmented, and that can be rolled up where economies of scale can be played, and there can be a lot of savings if you have a core support network that can, provide services to a broad geographic set of deliverable, businesses that do the actual delivery of the services. Home related services. Once you mentioned pest control. That's that, and things in and around the home, plumbing, HVAC, electrical, less construction oriented, more service oriented businesses. Even some chemical treatment for lawns and things like even lawn care businesses, believe it or not. Things with high degrees of recurring revenue where you get on a plan, and that person just comes and provides that service, and it's sort of on auto pay. Those businesses are hot right now. Things that weathered the recession well. To be leery are things that spiked because of COVID, and maybe start to be cooling off. And so, we see businesses that doubled and tripled their revenue in 2020 and 2021, and want to get a full multiple off that when everybody knows it's coming back to reality, and buyers know that too. And so
It's like the
that's
liquor
where you,
business. Yeah, the liquor
yeah,
business. I was looking at a few. Well, I guess it's been a month or two now, and he's like, "Why are your numbers so crazy and high for the last 2 years?" And turn around and they started making hand sanitizer during that time under another
right,
brand and this same stuff. It's distilled alcohol or whatever. I mean, they use the same equipment, I guess. So it was
yeah.
pretty easy for them to switch the line and make their own line of hand sanitizers. They're not going to stay up there with those big brands once the shelves are not cleared of them. So,
Exactly.
yeah.
Yeah, but no, I think there's always the markets that are sectors that are in favor, and those are some of the ones right now. The trick with those Amazon stores that you mentioned, and we've seen that same activity is, man, I'm just leery of when you've got so much of your business that's going through essentially one channel. A change in their algorithm, or they decide to look at your best sellers and knock them off. That there's risk there. So I agree with your advice to your friends of I'd get out while the getting's good.
It's interesting as they asked me, "Hey, you're buying business. You want to buy my Amazon store?" I was like, "I don't," and I just have to tell them, "I don't touch anything where a single party can ruin my day." Right?
That's right.
And I'm in Oklahoma. I'm surrounded by cannabis businesses, but it's not federally legal. So for two reasons,
Right.
again, a single party can end my day, right? And the
Yep.
second reason is I like to play in these larger team mergers and acquisitions projects, roll ups, and stuff like that. Some of those are international, and I can't put that team at risk because I'm involved with something that's okay locally that the federal
Right.
government could smack us, on the hand
Right.
anytime they wanted to. So I stay away from it, even though like there are more like cannabis, you would call it dispensaries between here and my house than there are gas stations and grocery stores. It's
Right.
insane. I live way out in the boondocks, and from the last point where like I can get groceries, I pass three dispensaries before I can get home. Right, out in the
Yep.
out in the boondocks. I'm talking like, when it snows, I can't get out of my driveway kind of place. I own a little private valley, but so I get the hot markets, and are there what's this like? Are there markets out there that just steady? They year in and year out. There's always a decent market for them. I'm thinking home services probably in that space, right? There's always going to be
Yep.
somebody out there that wants to grow their business. I know I do. I'd like to turn
Yep.
Lullaby Pest Control into, like I was telling you about, into Lullaby Home Services, mainly because if I have a cleaning service, what do the cleaning ladies find when they go clean behind stuff, right? They find bugs,
Yep.
or they call so it's an upsell, cross sell
Yep.
environment. A handyman. One of the biggest things I
Hmm.
have to do for that company is we have to call handymen out to do certain chores, like replace door thresholds and stuff like that, because exclusion, keeping things from being able to crawl in, is a
Right.
very valid part of the process. So,
Yep.
strategic acquisitions around that realm is somewhere I'm definitely doing that. But are there other industries that are just steady? I'm thinking probably marketing firms will never like just taper off, because people are always going to want to better market their product or grow their own marketing agency by acquiring somebody that's developed a talent or skill that they don't necessarily, have yet.
Right, yeah, where that expertise, and particularly that's an example where that world is ever changing, and it's worth paying people the expertise to have the expertise to be able to maximize in that environment for their clients rather than trying to figure it out on your own. So, yeah, I mean, I think that there's to some degree there is a case to be made across a wide variety of industries for all. It's finding the businesses that have a defensible competitive advantage, which can be in a lot of different ways, but can be achieved in a lot of different ways. Recurring revenue. Having some competitive moat around it where it's difficult to be outsourced, or sent to overseas. Strong relationships, lack of customer concentration, as you mentioned, not having one group ruin your day. But a topic that you touched on that I think is really important, I want to just hit on for a second, is another mistake I see business owners make is poor positioning when they go to sell their business. And what I mean by that is defining the landscape in which your business operates more broadly than you might think is really valuable. And so, your pest control business could be a pest control business, but it also could be the first leg of a multi-leg home services business where there are all these other tie-ins. And whether you've done any of the other ones or not, defining what your business is more broadly than what it actually does today helps to plant that seed in the buyer's mind that this is something bigger than just a local pest control company. It attracts more buyers that maybe weren't looking for that, but are looking for a multi-service, home services business, and this could be one element of it. And it helps show them that you've got bigger growth opportunities ahead of you than just simply adding on more of the same. And so it points to that opportunities example. And so giving that example can be applied to businesses across the board, and being a little bit more creative. You still have to be intellectually honest with how you describe your business, but being more broad, open-minded, and broad in describing and how you position your business. You get to decide how when the time comes to exit, how you want to describe it, and the broader the better.
Cool. So I've asked you a bunch of questions. We've talked about random topics. One of the favorite things I like to do is say, "What should I have asked? What did it? What you know? Is there anything that's come up in this conversation that you're like, hey, we probably should talk about that? The world needs to know it." Or, I mean, is there a question that we're skipping over here that I failed to ask you?
The one thing that maybe would be good to end on is, part of the reason I wrote the book, part of the reason that people like me still have a job is that I think business owners have a lot of misconceptions about exiting their business, and they fall into two polar opposite camps. And I just want to really quickly demystify or debunk both of them. One end of the spectrum says, man, selling my business will be very easy. I don't have to worry about it. When the time comes, the right buyer will fall in my lap. I don't have to do any preparation for it. I'm not going to think about it until the day I want to retire, and I'll just sell it like a house. Maybe it takes 60 days. The answer is it takes 6 to 9 months. But because of that misconception, they do none of the things that we recommend people do to prepare. The other one end of the spectrum is, man, it's so hard. It's going to be super expensive. I don't know what investment bankers do. It kind of feels like they get paid a lot of money. I'm not sure why. Um, and there's this angst, and they want to avoid it. It feels like a big dark cloud, and they similarly do none of the preparation work, and they feel like it's overwhelming. And the answer is it's neither overwhelming nor super easy. And if you find the right advisor to help you through the process, even well before you want to exit, um, you will be in much better shape. So just having all business owners will exit their business at some point, for sure. And they may do it on their deathbed. They may do it when the business goes out of business, or they may do it at the peak when all the stars align. But they're going to exit their business at some point. Rather than avoiding the conversation, understand it, work with an advisor before you need one, so that it's an active part of your strategy. Maybe you don't think about it every day, but every year you might reconsider, where am I, how's the business growing, and how are my exit plans evolving. So that's something you're actively thinking about, just like you would other types of areas of your business, and not something that you've stuck away in a corner and trying to pretend like it doesn't exist.
Awesome. So one of the things I want to make sure we get out there is your contact information and stuff, but also if if people hear this on podcast and they're listening to watching it on YouTube and stuff, and they have like a business that's ABC and they want to do XYZ, what is your target market? Is there something like, if you've got X, Y, and Z and you're wanting to do this, then you should probably give me a call? Or is there a pretty broad spectrum of what you're looking for? Or is there something that you could just tell the audience that, hey, if you got this, I'd really like to talk to you?
Absolutely. So we specialize in working, thank you for asking, with business owners, privately held businesses, really anywhere in the U.S. That want to think about, either they're ready to exit or they want to talk about a plan to exit at some point in the future. We're in that investment banking range, so typically, 5 million of revenue or more. That's not a hard and fast line. And we know a bunch of great business brokers that, if you want to reach out and you feel like that's the better option to go, you've got a smaller business, I'm happy to help send you in that direction as well. But really, people who want to to get comfortable with this side of their business, the side being planning for an exit, or actually, we think the time has come to exit. That would be the way to reach out to us. And, if you think about a timeline, a business owner will typically, a new buyer will want some type of transition after closing. A process can take, 6 to 9, maybe 12 months. You got to be, and there's a little bit of preparation before that. You got to be a couple years ahead of when you actually want to walk away. And when you start to add up those timelines. So it's really never too early to start to reach out.
So for your contact information, I have your LinkedIn. I'm gonna put that up real quick. Verify that for me. So if you're watching this, you can see his LinkedIn URL.
I think so. That's right.
Awesome. If you're listening, it'll be in the show notes. So go to whatever app you're using, Apple or Spotify or Amazon. We're on all of them. But if you look at the show notes, the links to contact Jonathan will be in the show notes. And if you want to reach out to me, they'll be there in there also. And then he gave me your email address inside of the intake form. Do you want that displayed on here?
Sure, that'd be fine.
Okay. So this is the email address. It is jonathan@transactcapital.com. And
You
I
got it.
don't put those in the show notes, so you got to write that down. His name is spelled Jonathan, Jonathan, at transactcapital.com. And the reason I don't put those in the show notes is the spammers can actually scrape them out of there if it's in clear text like that. So I'd rather
Thank you.
not get a bunch of junk because we put this all over the show notes. But it'll be on the video. You can go to YouTube, watch it on there. It's actually posted on the screen, or you can rewind, listen to that a couple times. Again, it's Jonathan, spelled Jonathan at transactcapital.com, TRANSACT capital.com. So I appreciate you. Is there any parting notes? We're right getting close to the hour here. Is there anything you want to say to the rest of the world here?
No, thank you. It's going to sound like a shameless plug, but whether it's me or someone else, when you come time to exit your business, use an advisor. Just like you would for a real estate transaction, don't sell on your own. Find an expert that can help you do. You want to do it once, you want to do it right, and so find an advisor that you trust that can help take you through the process.
And I'll second that. If I'm looking at something and you don't have all your last three, if you don't have a package together to show me like who you are as a business, your last three, your financials, profit and loss statements, um, kind of your plan where you were planning on going. If you don't have all that, it drags the process down. So if you're
Yeah.
working with an investment banker and you guys have got what they call a deal room or an exit package or something for me just to
Hmm.
look through real quick, I can put together a team fairly quick to analyze a deal if the information is there. I walk away from a lot of stuff. It's not if it's not really super sexy money wise or just intriguing. If you don't have your act together, I won't even look any deeper. And I know a lot of my guys that I work with and talk to, they're the same. So
Yeah.
that advisor is going to make a world of difference in getting people who are wanting to put together a team to actually buy your business. So I appreciate you having you on here. Hang out a couple seconds after I end the live stream, and
All right. Thank you for having
again,
me.
it was fun.
The Investors and Entrepreneurs Professional Mastermind. The Investors and Entrepreneurs Professional Mastermind combines the traditional peer-to-peer mastermind introduced first in Napoleon Hill's famous book, Think and Grow Rich, with accountability partnering, where your peers help you ensure that you set goals, take actions, and get results. If you want to scale, blow past roadblocks, and achieve success faster than you might think is possible, I suggest you take a visit over to tiepm.com. That's tiepm.com and check out the Investors and Entrepreneurs Professional Mastermind.